So today on the episode, we're going to talk about high return apartment buildings, and you need to learn a couple of different things. It's cap rates, leverage, where to buy, what your exit strategy is. I've learned this through I've looked at probably thousands of units. We bought hundreds of units over the last couple of years. So you get to know pretty quickly, what cap rates make sense, what locations make sense without ever even going to the property. So I'm going to try to teach you a little bit about what I've learned, some of the stuff that I look at, what's important when you're starting out, and hopefully give you some understanding of what to look at, what not to look at. For sure, when you're new starting out, I think the thing that most people look at is cash flow. And it's like, what's my cash on cash return, or what's the cap rate of the building? I know I was that way starting out. You just wanted as highest cap rate as possible. And at the time when I wasn't buying yet, I would look all over Canada and I would basically base it on that. You'd look at what's the cap rate, because in your head, it's like, that's the amount of return I'm getting out. As I've got farther along with it, I've definitely changed that and understood that a cap rate is essentially an indication of risk. So if you're buying an 8 cap building, it's either in a market that's not going to be great, or the building needs a lot of work. Something, there's a reason that's not trading at a 4 or 5 or 6 cap, right? And I think there's a sweet spot where it makes sense. We like to buy stuff that's right around a 5 cap. So for people who don't understand, a cap rate is essentially means if you paid cash for the building, what are you getting in return? So if you bought at an 8 cap and you put $100,000 in, you'd get 8% return. At a 5 cap, you'd get 5% return. But what that also means is on the value of that building on the upside. So if you go to buy in a small market, which is where you're going to get higher cash flow properties generally, because there's less competition there and there's less upside in the building. So if you're really stuck on an 8 cap, you're probably not finding that in most major cities. You're going to be buying in a submarket, and you go buy there and you get that cash flow. But if you're really good at managing and you're really good at operating and you can get the income up on that building, the odds are you're going to be selling it just because of the market it's in at an 8 cap. So at an 8 cap, every dollar of value, every dollar you can increase the revenue or decrease the expenses is worth about $12.50 of upside in the building, right? So that opposed to buying at a 4 cap where every dollar is worth $25 of upside. So that's where you can see where sure you get a little bit more cash flow up front on a higher cap rate building, but on a lower cap rate, there's way more upside. If you can get $1 extra in rents on the 4 cap building, you added $25 of value to that building versus at an 8 cap, it's $12.50. So you have to kind of look at what your model is. If it's just based on cash flow and you're going to hold the buildings forever and never sell it, then yeah, you can go buy those higher cap rate buildings in the smaller markets. And if you're saying, hey, we're going to build wealth long term, we want to build appreciation, then you can buy, a lower cap rate building. And there is a sweet spot where, when I started investing, interest rates were around 2%. And now let's say they're around 4 or 5%. We can't buy a 4 cap building with a 5% interest rate. Like, that doesn't work. When interest rates are 2%, you could, and there was still a nice spread there. So you have to use some sense of, find where you're comfortable with that number. You still want some cash flow. That's what makes the investment safe. Again, what we're buying right now, everything's in that 5 to 5.5 cap range. It was higher before when interest rates were lower. And we'll see if that changes. But we expect to sell at a similar cap rate, right? If all of a sudden everything in Edmonton went to a 6 or 7 or 8 cap and we had to sell at that, our value would drop. And likewise, in the smaller markets, if you bought at an 8 and you could somehow sell it at a 6, you'd have a huge upside there, right? Every dollar, even if you didn't do any increases, every dollar is worth a lot more at a lower cap rate. So understanding that, I think, goes a long ways. And when you're looking at deals, don't just look at cash flow. Look at where it is. Location's very important. I mean, if you're happy to do it in small markets and get the higher cash flow, that's fine. But what does that look like to manage it, right? Because most small communities don't have enough that you can build a meaningful full portfolio inside that community. So you're going to have to find another small community. Now that makes it very difficult to manage. There's not a lot of management companies in small communities. So that model, in my opinion, gets hard pretty quickly. You can do submarkets like right outside of cities, and you're kind of going to get a blend of the two, right? You're not far enough out that you're getting super high cap rates, and you're close enough to the city that you can probably get management. But you have to look at, what does it look to manage? If you manage in different provinces, there's different rules, and you have to really look at that when you're picking where. I think to start out, it works the best to do it locally, just for the fact that if something happens, you can go to the building and you can see what's happening. You can talk to the company that's managing it all the time if you're not doing it yourself. And even inside a city, the cap rates will change based on the neighborhood, right? If you're in the best neighborhood, it's going to be lower. If you're in the worst neighborhood, it's going to be higher. That doesn't mean it's a better investment because it's higher. Higher cap rate in Edmonton generally means, you're going to have a worse tenant base, a lot more tenant turnover, which is going to cost you more. So if you run the numbers on a brand new building in a great location at a 4 cap and one that's run down at an 8 cap in a bad location, and do it over a 10-year period and say, what are we going to put in CapEx? How many units are we going to have to renovate? How much turnover are we going to have? The investment's not going to be a lot different. So don't get bought into just looking at high cap rates. I think, you have to find something that makes sense, both from an equity upside perspective and a cash flow perspective. So another big piece of real estate is the leverage you can use, and that can really dictate, how much cash flow you can get out of a building. You have to be very cautious because you can leverage so high today, right? So if it can absolutely explode your returns. If you put 5% down on a building and the building goes up 10%, you didn't make 10%, you made 200% on your initial money. So that can be really enticing. And it also to just get a percent number, like if you buy a small building and you put $50,000 down on it, to get a 10% return, you only need to make $5,000 a year. So that's a 10% cash on cash return. That sounds great. I guess just understanding the risk that goes with that. You're so close on debt cover with those high leverage loans that it's very easy for that 5,000 to be negative 5,000, right? That's one or two tenants trashing an apartment or not leaving and you have to evict them. So on a piece of paper, your cash flow can look really good when you use high leverage. And in reality, it can be the opposite. You might have to put money into that property for a year or two to get it stabilized so it actually is cash flowing. And it can, like I said, it can absolutely explode your returns, but it can also go the other way where if interest rates change a little bit, if you took a 5-year term and you barely paid the mortgage down, if interest rates all of a sudden crept up 1 or 2% and your building value didn't go up, that's going to be very hard to get out of that. You're going to either have to put a bunch of money in or you're going to have to sell the property and probably lose money. So leverage can be a great tool for building wealth, can expedite the gains, but it can also be a big negative. The part about leverage that always, I guess, gives some level of safety is if the bank is willing to put in 95% of it, they obviously feel pretty comfortable in that asset, right? They're the biggest partner of it. A lot of the 5% down loans, you can get very low recourse. The bank's willing to give you 95% of the equity and they'll give it to you over 50 years. They wouldn't do that even to buy their own stock, right? You couldn't go to TD and ask for that same loan to buy TD stock. They wouldn't do it. So they're more comfortable with this asset class and this asset. If they have to take it back, they don't mind doing it because they feel comfortable they could sell it at 95 cents on the dollar. So then the last piece is kind of your exit plan. And that's going to have a big impact on what you buy as well, right? Because the problem is if you buy in a bad neighborhood and you buy at a high cap rate and you spend all this money on the property and you get the rents up, the building should be worth more. It should trade at a higher cap rate. But if the neighborhood has a bad stigma, if that's the reason it's sold at that cap rate, it's going to be very hard to get someone to come in and pay a cap rate that they would pay in a good neighborhood. So sometimes, or the buildings that sell at the higher cap rates that have all the stuff wrong with them, that's attractive to people whose whole model is going in, renovating them, getting the rents up and refinancing or selling. And you lose that buyer when you go and do all the work, right? If you go and now all of a sudden you have from a C class building to a B class, all the people who would have bought in that neighborhood because they were going to do the same thing you would have, or they're going to buy in a small community, so they have all that upside. They don't have that anymore. They just kind of have steady growth, and that's a totally different buyer than you or the person who bought it initially. And I think that buyer is a lot more picky on areas. A long-term buy and hold person is going to be a lot more picky what area they buy in. So you have to watch that, what you're going in. I know a lot of groups they'll go in and they maybe do 50% of the units. So they prove it out and say, hey, here's what we can do. We can get the rents up $200. We've done it in these units, but we're leaving 50% of them for the next guy, right? So there's still meat on the bone. So another flipper or another person who wants to do that model can come in. They pay some upside. The model's already been proven. Maybe some of the big stuff's been done, but they still have 50 or 30% of the units that they can go. So there's enough upside for them that you can still have a buyer in those neighborhoods and with those cap rates. So today we were talking about how to find a good cash flowing building, what to look for when you're first starting out. So we touched on understanding cap rates, how they impact your investment, understanding leverage, how that can impact your investment for the positive or the negative, and your exit plan. You need to have that going in at the beginning, and it will really dictate what you buy is who you're going to sell it to on the exit. Thanks for watching this week. We'll catch you guys next week.